Welcome to this episode number 74 of Your Next Trade. Code today, September brings violence. So for the second time in less than 6 weeks, the market experienced a big move in terms of volatility. So a volatility event where now the VIX is above 22%. As you remember or not, at the start of August, we went above the 60%. So what we mentioned last weekend is the market has been trading in a range. If you look at the S&P futures here, the S&P was trading between 55.80 and 56.60, pretty much in a trending range over 10 to 15 days, and we were expecting this trading range to be broken. The biggest reason was, at the start of September, what you have is people come back to their desks and they take new positions. So our expectations were with a low conviction for the market to go higher. We were mostly expecting, a big move after 10 days of congestion. But, the calls and the what we had was a positioning for the S&P in terms of options, especially for the end of September, with a lot of calls for around the 57.50, so almost 100 points higher than the top of the range. But what I missed, and here I made a mistake, it was back to from the summer, and I didn't do my daily routine. What is my daily routine? One of the things that I do every single day is I will be checking at the end of the day, what have been the biggest options that have been trading on the US market and the European markets. And I missed something very important, which was Friday, 10 days ago, which was we had a big call spreads that traded the 22.30 on the VIX for 350,000 more call spreads. And by definition, what I should mention, that was for the 18th of September, for the maturity of September, just after the FOMC meeting. So when you have such a big position, the market makers will have to hedge that position. That was done on Friday, so pretty much not much time before the long weekend. Monday was Labor Day in the US, and then on Tuesday, this is what happened. The market started to go lower and the VIX going much higher. So again, we were expecting a move. I was expecting a move higher, but the move went much lower. One of the reasons is we got a second volatility event. The market is not that liquid for the VIX, but this is what has been happening. Second thing that is pretty clear and that we mentioned is September normally is not a good month in terms of seasonality, especially, the first 3 weeks of the month. I was expecting actually going into the expiry pretty well and then having a bit of a hiccup. That was the other way around. I strongly advise you to stay until this end of this video because we're going to be discussing about the risk reward of being long and short at this level after such a move. So let's jump immediately into the week to date asset performances. Looking at the stocks here, we do have for the US stocks that were down 5% on the week. So this is one of the worst week for the S&P over the last couple of years. A really big move where most of the macro news were a bit lower than expected, and what has been happening is anything that is bad was considered as bad for the market. So bad is bad these days in terms of macro. If we look at the risk off, it's true as well for the crypto space, down 10%. We have been trading sideways for the dollar. Having said that, a strong yen that was for the week. So let's look now into the week to date industry performance, because this one is the most interesting one. Two things that are outperforming, obviously rates. So yields have been coming down on the fear of the slowdown of the economy. And, so far the market has been pricing the economy going soft into soft landing. So the economy doing fine, slowing in a good way. Now the market is more and more pricing the chance of less soft landing. And as we can see, what is very important is the most recent leaders. We are talking semiconductors, for example, have been down 12% on the week. So What we mentioned over the last 6 weeks is the market is now struggling to find new leaders, and you need for the market to go higher most of the time to have leaders pulling the market higher. So on the left-hand side, we get semiconductors, we get oil services, we get technology, we get steel, we get cybersecurity. So a lot of things that are telling us if we go into the sector performance. If we look at technology, minus 4.4% on the week, when the S&P is only down 4%, should I say? But that's and anything that is defensive, consumer staples, small up, utilities flattish, real estate, flattish. So overall, we have seen a risk-off, but not only for the technology, but as well on a fear that the economy is slowing. So how does that translate into the rates? Guess what? The US 10 years is down 20 bips. So we went from 3.9% to 3.7%. I don't do technical analysis on 10 years, but there's, the levels that we are probably targeting now are 3.3 to 3.5%. But as you can see, the US rates have been the ones that have been moving the most for this week. As well, we have now the 10 versus the 2 that is now positive. So we went from negative here to positive. Over the last couple of years, we had an inversion of the yield curve. As I've been mentioning over the last few sessions, it's pretty much when we go from negative to positive in the 10 versus the 2 that we are probably going into recession. So this is something to monitor. And the second thing that we want to monitor in that space is the Fed fund rates and what the market is pricing. So are we pricing a 50 bips cut or 25 bips cut for September? For the time being, if I compare the 520 to 550, the odds are for 25 bips. So we have the FOMC meeting in 10 days time. So there's going to be a lot of moves into that space, but so far 50 bips. If we compare what we have as of Friday versus at the end of the month, so if we look more importantly here at 443, 452, as you can see, everything has been coming down. So the market is more and more expecting the Fed to be dovish and cutting more aggressively in 2024 and in 2025. That is not only because CPI has been coming down, but mostly because the economy is slowing. We had not bad NFP. We had a bit lower NFP numbers on Friday. We get ISM manufacturing that was not great, and ISM services as well not great. Finally, into the VIX space, 22.38. As you can see, so we had the first event that was end of July, start of August. Then we get the second one. Pretty much, the VIX is just a reflection about the uncertainties seen by the market participants about the economy. When volatility starts to go higher, it's not just about magic, it's as well because most people will think, or some people will think that, there are a bit of unknowns. So it's like you want to price and hedge yourself through insurance, and that will be using the VIX. So that tells you that market participants are more indecisive about the future of the US economy, and there are some unknowns that are building. So let's look at the chart now. Now I want to keep what we have been discussing, which is looking at the monthly chart. And what I was saying is, all these August candles were looking pretty good because we had a huge recovery. And look now what a week has been making and really taking a dent in this overall market. This is pretty much the same for most assets, where we had a 3 to 5% way down. We are talking CL1, we are talking copper. So here we are talking oil, and I think oil is interesting. I've been mentioning in the community that 67 was the level to be watching. So if it goes lower, that tells you that the market will be pricing even more recession going forward. Looking at euro dollar, looking at the dollar yen. So most of those assets, it's pretty clear that we have been talking about a week risk off, and that's the same if we look at Europe through the stock 600 and with the DAX. So pretty much a very different picture than that we have for last week. As we said, We were trading in a range. We were expecting market participants to come back, and August very much is a bit of a struggle because you don't have much volume into the market. Now we are all back into the desks, and let's see what happened for the week. So this week we had the trading range that was broken. So that was your trading range. We started the week on Monday, no work in the US, and then we started to sell off, and we carry on. So we had the ISM manufacturing and the ISM services. The manufacturing, as always, should I say, was a bit lower than expected. Where the different components were not that great. ISM services were in line. NFP, we are talking 142. So this is the number that we have here. And as you can see, the trend is pretty much clear. We are going lower and lower. 142. So that tells you if we keep with that direction, we are talking, probably at the end of this year, a bit of struggle for job creation. Why is it so important? We do know that NFP is a lagging indicator. That's not the point. What is important is we do know that the US economy has been very strong. One of the biggest reasons has been the US consumer doing pretty well. If people start to lose their job, by definition, consumption might be struggling, and then that gives you a domino effect into the economy. So that's really the space to be looking at this NFP, at those weekly claims, ISM, a leading indicator to tell us, how is this market going forward in terms of the job market. So leaders, we said it, they have been punished. We get the bad seasonality, that is pretty clear. And I want to say as well, anything that is for the macro bad is bad these days. So it's not like because the numbers are lower, we are expecting the Fed to be cutting and the market and the stocks going higher. This is not the case. Bad is bad because that makes the odds of having a soft landing going down and a hard landing, the odds going higher. So as we can see here, looking at this chart here, this is the S&P on the left-hand side futures versus the CL1, which is for the crude. As you can see, strong correlation in terms of risk off, where we have been trading the same. So what I'm interested as a trader is always to identify the leaders, the laggards, and how the different correlations have been doing. So if we look at the S&P before, for a month, it was trading the same as where the US 10 years was trading these days. It's all the different assets that will tell you if we are going into a recession. So what about the catalyst going forward? This is important because now the market is only 4.2% down versus the recent highs that we had in August. So what I'm interested as well as a trader is about the risk reward. So each time I put a trade, I want to know my upside and my downside. And obviously I want to have higher upside than downside, but this is the odds as well that I'm interested. So I spent a bit of time yesterday at looking, how the market has been doing so far in terms when we have a drawdown. So I looked since 1945. So since 1945, the S&P 500 has been down 26 times, more than 10%. So overall, once every 3 years, you get the market, the S&P that is down more than 10%. When was the last time that we had more than 10% correction? That was in 2022 when the market was down by more than 25%. So now I'm interested into two things. I'm interested into the soft landing and I'm interested into the hard landing. Why? Because I do know that when you have a soft landing, this is more or less the case where you're going to have a 5 to 15% correction. So this is your yearly correction. Could be 5%, could be more than 10%, but we are not talking big numbers. Versus that, you're going to have the hard landing. Okay, hard landing means you go into recession, your EPS are going to be coming down for year on year versus what the market is pricing. For the time being, we do know that the market is expecting EPS in 2024 to go from 240 to 280 for the S&P. So roughly $40, 15% growth. 15% growth versus an economy that is struggling and that is slowing. More or less what you're going to see is for sure we're going to see analysts downgrading their numbers. That has to be happening. But what happens is by how much the market is coming down when there is a recession. So the average drawdown when more than 10% it's roughly 22%. So a big number. We are comparing on average, if you think that it's going to be more than 10%, 22% versus your 4%. So if you decide to go long, where, making the highs is 4%, where the average correction of more than 10% is 22%, you are looking for trouble. Second thing is, if you think that there is a recession coming, then your average drawdown is 33%. So if you look at 2000, if you look at 2007, 2008, if you look at 2020, even if it was a very short recession, we are talking correction between 30 to 50%. If you think now this is not a recession drawdown, then you are talking only 17%, but still that is 17%. So what does it tell you finally is, the average intra-year drawdown is 13%. So risk reward, you get 4% on the way up if you want to be making the new highs. Best case scenario, if that's only a 10 to 13%, you have another 5 to 9% downside. If you go into soft landing, that could be another 15% downside. If you go into a hard landing, you are talking about 25% plus. So, in other words, for the time being, we got a VIX event where volatility has been on the way up. As I said, that tells you that market participants, are expecting, are looking at the market with more unknowns than before, because we are pricing more uncertainties through the NFPs coming down, through higher, probably too high EPS going forward. You got the elections coming. So many things that are building for this volatility. So going forward, what are the catalysts that we have for this week? We got the CPI, not so long ago, inflation mattered. What the Fed has been saying is inflation is coming down, don't worry. It's mostly about the job market and how the economy is doing. I just want to share, how the S&P have been moving on CPI day most recently. What is interesting is, the market has been moving by roughly 80 bips on any single CPI recently. What about what the market has been pricing for the move for this week, plus minus 2.2%. What is important to see for this week is anyone that has been buying volatility has been doing pretty well. So if you look at buying straddle on the daily, on the weekly, so last week I think the weekly straddle was 1.3% and we did much bigger than that. If you look at the NFP straddle, that was pricing 1.3 or 1.4% and we did 1.7 or 1.8 on the S&P. So for the time being, the long volatility people have been in control and has been working pretty well. So we have as well the ECB rate decision, if Europe matters, with the 25 bips expectations cut. Finally, we do have like the FOMC blackout period. So we should not be expecting the any FOMC person to be talking this week. Why? Because we get the Fed meeting, FOMC meeting in 10 days. So the expectations will be on Wednesday in 10 days, where it could be between 25 and 50 bips. And finally, we do have like some earnings conferences. So we got Oracle on Monday, but more importantly, we got Apple with a lot of expectation with their iPhone. So overall, we broke this trading range. We have been coming lower. This is the second time that we have volatility going much higher. As I said, September is not a good month for stocks. You have elections coming. And finally, if you look at this risk reward, again, as a trader, this is what you should be looking at always. What is my upside? What is the downside? What are the scenarios? And then you trade on them. You say, I could be, if the market goes up again, we are talking 4%. What is my downside? What are the odds? Okay, probably 90% of the time, it's a small correction. We are talking between 5 to 10%. When it's more than that, 10% of the time, we are talking about a correction that could be between 15 to 50% actually, and we are talking on average a 23% downside. So 23% downside 10% of the time. 90% of the time, we are talking about 5 to 10%. Okay, so let's say it's a 10%, so that gives you 9%. You add the odds of a big correction versus your upside. And as you're going to see, you can make the calculation. The odds are not in your favor right now to be long the market. So this is it for me for this week. If you want to know more, if you want to understand how we do this process, you can join the trading community. We are on Discord. I'm still doing the mentoring. There is the 4x4 video series. Any questions, you can reach me at greg@duponttrading.com. And finally, have a good trading week, and I see you next week. Bye-bye.